Alright guys, it's me again, guys, your BFF tutor, Mr. Gumede. Now for today guys, I want us to focus on paper one as we've been doing. But today we'll be focusing on ratios, your interpretation and analysis of financial statements, guys. Guys, the ratios is one of the topics that I want you guys to score marks on. I need you guys to get A pluses for this. You're just analyzing and interpreting information. Okay. So guys, yeah. Ratios. So this is applicable to grade because we're gonna start with the beginning ratios, the first ratios, which is your profitability and your liquidity. So it applies to grade 10, 11, and 12, and varsity and college. All right, ratios. I want us to start with liquidity because I've been seeing people struggling with this. Now, what is liquidity, guys? Because I'm sure we've seen this word before, and we've seen it from our past year papers, from our past grades, and our exams. So, liquidity. In terms of liquidity, we'll be talking about 6 ratios here. I need you guys to remember these 6 ratios. They are not hard. It's just for you to go and practice and remember these. So the first one is current ratio. I know you've heard about current ratio for 3,000 times. Current ratio. So this is a revision, so I'm just going to be summarizing some, but I'm going to be teaching all of it. Okay, it's okay. Now, what is the current ratio? What do we want to see here? Now, the current ratio, we want to see if with our current assets, would we be able to cover our current liabilities? So guys, we started with balance sheets, so we now know that current assets, there's 3 things. We have inventory, trade and other receivables, and cash equivalents. So you need to know your balance sheets before you can be able to analyze it. You can't analyze something you do not understand. So your current ratio, the formula is current assets is to current. So I want you guys to have your books out and taking these down. Don't just look. You can't just look at accounting. You need to have your pen and your paper and your calculator so that we will be able to master this. Remember, we're mastering accounting here. So remember, now let's say our current assets is 50 and our current liabilities is 100. So what you will do is you will take your current assets divided by your current liabilities. So it's going to be 50 divided by 100, which is going to be giving us 0.5. Now the answer that you will be getting, you'll equate it to 1. So it's going to be 0.5 is to 1. For every 1 current liability, there is 0.5 current assets. Now, by looking at this, you as a business, do you want your current assets to be bigger or do you want your current liabilities to be bigger? Obviously, we want our assets to be bigger than our liabilities. So we do not want this to be like this. So if you ever find a ratio like this, it's not good. This is not good. Now, ideally, when we calculate this ratio, we want this ratio to be around 2:1 or something similar to this or something close to this. It can be 2:1:1, can be 1:9:1, but something close to 2:1. For every 1 current liability, we need to at least have 2 current assets, okay? So even if it's 1:9:1, that's okay, that is fine. 1:8 is fine. But at the same time, please pay close attention here. At the same time, we do not want to have this ratio be 5:1. We don't want this ratio to be 10:1. We don't want it to be like this. Yes, our current assets funa abe makhulu. We want our current assets to be bigger, but if they are too big, it is a problem. Now you're gonna be like, Aibo, say, why are we saying we do not want our current assets to be too big? Because our current assets are good if they are big. Now remember, our current assets consist of three things. Remember, we have cash and cash equivalent, right? Number one. Number two, under current assets, we have trade receivables, people that owe us money. Then we have, what do we have? Inventory, which is our stock. Now, if this ratio is 10:1, it may mean that we have too much cash and cash equivalent, or maybe we have too much trade and other receivables, or maybe we have too much inventory. Let's start with inventory. Do we want to have too much inventory in our business? Because remember, inventory is a stock. Yes, we want to have sufficient stock levels, but we do not want our stock to pile up. Reason why: our stock can get damaged, our stock can expire, depends on what we are selling. Our stock requires us to insure it. So if there's too much stock, insurance will be high. Holding costs, security, and all of that. So we do not want our inventory to be too high. That is why we don't want this ratio to be too high. Maybe our stock is not too high. Maybe it's our trade and other receivables that is increasing this ratio. Why don't we want our trade and other receivables to be too high? Now, what is trade and other receivables? Remember, trade and other receivables is the people that owe us money. Just basic terms, okay? If people that owe us money are too many or are too much, there is a high risk of high bad debts. For example, when you as a student, does this person you owe money or that you lent money, and even now, up until today, they have not paid? That's the thing. If people are owing you, most people won't, maybe not most, but people in general, if you have 100 people that owe you money, some of those people will not pay. So we also don't want our trade and other receivables to be high, because people do not pay. And if they take long to pay, there's high risk of bad debts. That is why we do not want this to be too high. Maybe it's not that receivables that are too high that are making this ratio too high. Maybe it's cash and cash equivalent. Now, cash and cash equivalent, remember, this is the money that we have. Bank, cash flow, petty cash, whatever. Okay? We do not want to have a lot of money or too much money in our bank. Now, my students always laugh at me when I firstly say this before I even explain. They're like, oh, sir, we do not want to have too much money in the bank. What are you saying? We are Now, remember, the money that is in our bank account, in our savings account, if it is there, staying there, it does not make us more money. Instead, we get charged for putting it there. So, if when you have 1 million in your bank and you do not need it for the next 12 months, why not just take this 1 million or maybe 900,000? I don't know, up to you, and just put it in a fixed deposit. Why don't you just do that? We file with fixed deposits, because money that is here in our bank account is not earning us any money. So we do not want our cash and cash equivalent to be high. We just need to have enough cash at the bank to cover our needs. Okay, not just money that is just watching us. I mean, guys, come on, we're a business. We don't just want to enter our apps and just, too many zeros and be happy, while that money is not making us any richer. Okay, so guys, we do not want this to be high, the ratio. At least it must be around 2:1 or anything close to that. But at the same time, we do not want our current assets to be less than our current liabilities. So that is it for the current ratio. Please make sure that you take down all of this because it is super important. Then next, then we have acid test ratio. Now this one is similar here, but the difference is we want to see if we are still able to pay our current liabilities even without us needing to buy stock. So the ratio for the to sell stock, current assets minus inventory is to, I'm just gonna say CL. The CL is for current liabilities. I just did not have enough space. Now, as a business, we want to know if we will be able to pay our current liabilities if we are unable to sell our stock or without having or needing to sell our stock. Okay, now this ratio here, we want it to be, maybe it can be 1:1 or somewhere between 1,5:1. If it's around here, it's good, it's okay. We also don't want it to be 5:1 for the reasons that we stated in the previous ratio. Obviously, Pelala, we do not have inventory anymore. So if it's around here, it's safe. So here, it's current assets. Remember, current assets, there's three things: inventory, trade and other receivables, and cash and cash equivalent. You add all of those, and then minus the inventory. Okay, so that is our asset test ratio. Then we talk about our stock. Firstly, we have stock holding period. Stock. In terms of our stock holding period, basically we want to know that how long does the stock that we purchase stay with us before it is all sold. Okay, holding period. We do not want our stock holding period to be too high because we want to sell our stock as fast as possible. Now the ratio for this one is going to be average inventory all over cost of sales times 365. Sometimes sometimes it's not times 365, sometimes it's times 12. I'll explain why. Sometimes you are asked to calculate the stock holding period in days. If they want days, you are going to times it by 365. If they want months, you will change that 365 into 12, okay? Because there's 12 months in a year. Now, what do they mean by average inventory? Remember, we now know what inventory is. Average inventory, we will be taking inventory last year. Last year's inventory plus this year's inventory. After adding these two, after getting the figure for these two, let's say it's 1,000, you will divide it by 2. So it's last year plus this year, you get your total for these 2 years, then you divide it by 2. That is your average. Take both years, then you divide it by 2 to get your average. Now we all know what cost of sales are. So this is the part that you need to remember. Last year plus this year is equal to 2 divided by 2. If it asks you for days, it's going to be 365 times 365. If it's months, times 12. Obviously, sometimes or most of the time, they'll ask you to compare with last year's. Let's say average or stock holding period last year was 35 days. Last year, they gave you 35 days. Then when you calculate to get 40 days for this year. This is not a good sign. Remember, we want our stock holding period to be as low as possible because we do not want to hold on to inventory for too long. We firstly need it to be an improvement from last year's. This is not an improvement. Instead, this is a decline. So if it has declined, you'll have to comment average okanye stock holding period has declined from last year's 35 days to this year's 40 days. Yabo. Then again, you'll comment what can we do as a business to improve that, to make our stock get sold faster. Okay, so stock holding period dileba kwethu ikanje. Then we have stock turnover rate. Now stock turnover rate ke izothi cost of sales. Now the cost of sales are up all over average inventory. Remember, when we are saying average inventory, we are saying last year plus this year equals to, then we divide it by 2. Now, the stock turnover rate, to put it in simple terms, the stock turnover rate is how much or how many times do we sell all of our stock and reorder more stock. I'll repeat that one again. Stock turnover rate. How much are we finishing the stock that we buy in a year? Let's say we bought stock in January and we finish it in May. That is the first, number one, that is 1. Then you buy stock in May and we finish it in October. Finish selling it in October. That is number 2. So then we buy stock in October and we finish it in December. That is number 3. So in other words, our stock turnover rate is 3 times. We bought stock and we sold it on May, and we bought stock and we sold it by October. That is the second stock that we reordered. Then we ordered again the third one and we finished it. That is our stock turnover rate. Obviously, we want our stock turnover rate to be as high as possible because we want to sell and finish all of our stock as quickly or as frequently as possible. Stock turnover rates, we need it to be as high as possible. So if you are given last year was 5, and when you get this year 8, this is good. This is an improvement from last year's 5 to this year's 8. So now stock sesiphela ka 8 onyakeni. Last year stock sesisorder ka 5, siphele ka 5. So always remember, stock turnover rates, we want it to be as high as possible. All right, that is the 4th one. Then we talk about our debtors and our creditors. Then we have debtors collection period. Debtors collection period. Now we want to know, on average, how long does it take our debtors to pay us back? That is, a debtors collection period. Obviously, we want our debtors to pay us as fast as possible. So the formula for this will be average debtors. I mean, some debtors are the people that are the people that owe us money. So they owe us money because they bought on credit. So all over credit sales. We want to know how many days do they take. It's going to be 365. When we are saying average, as we were saying before, we take last year's debtors and this year's debtors. We get the total and we will divide it by 2. Then we get our average debtors. Credit sales are the sales that we sold on credit times 365. Then we'll be getting our debtors collection. We want this number to be as low as possible because we want the people that owe us to pay us fast. We don't want this number to be 60 days. We want this number to be around 30 days. If it's less than 30 days, even better, because we want our debtors to pay us as fast as possible. Obviously, you'll have to compare with last year. If last year it was 60 and this year it is 30, that is a huge improvement and is a good thing. But if last year it was 30 days and this year is 60 days, that is a huge decline and we need to do something about it. What can we do to make sure that our debtors are paying us early? We can send reminders, we can charge interest if they do not pay on time, or we can offer discounts for those that pay us on time. All right. Then we also have people that we owe money to. We also have creditors. Creditors, we need to pay creditors. Creditors payment period. Now, a creditor's payment period. This is basically us wanting to know ukuthi, how many days on average does it take us to pay our creditors? Now, if formula gets so again now, average creditors, so it's last year plus this year divided by 2 all over. How are these guys creditors? It's because we bought from them on credits. So it's going to be all over credit purchases. All over credit purchases times, we want this in days, so it's going to be times 365. Obviously, when we are interpreting, we want our debtors to pay us before we pay our creditors. So here, if it is 30 days, we want this to be more than 30 days. So we always want to take time to pay our creditors, but we need to be careful. We can't just take a lot of days, because if we take too much time, our creditors will no longer offer us credits. But we want this figure to be lower than this. We want them to pay us first so that we can pay these guys. But at the same time, we need to be careful. We shouldn't take advantage and pay in a long time, because these guys will no longer offer us credits. Okay, so when you're commenting about creditors payment, always make sure that you mention your debtors collection period. Okay, so guys, basically this is it when it comes to illiquidity. This is illiquidity too, just like this, straight. And yeah, guys, come on, yeah, we can't be struggling with doing this. I want you guys to watch this, practice this, then we'll be able to do our question papers before we write. Okay, so guys, that is it. It's me again, your BFF2 Tamateta Mr. Gumete. Alright guys, see you guys soon. Talent practice, always make sure that you practice and do your best, because your best will never let you down. See you guys soon.